After the event of a crisis has been long forgotten, the impact may still speak even years later. This was the case when the giant Ever Given container ship blocked the Suez Canal. Countries, companies, and industries around the world suffered a great deal from this incident, and that went on for several weeks, but it was nothing compared with what international trade and supply chains had to bear. Yet surprisingly, in the face of this seeming crisis, untold opportunities abound for the global space. Prior to commencing, please ensure to click the like and subscribe buttons to stay up to date with the newest content. In 2021, a 400-meter cargo vessel, more than double the size of Statue of Unity and a quarter-mile long, blocked Egypt's Suez Canal after losing control while entering the narrow passage from the Red Sea. The Ever Given, which got stuck in Egypt's Suez Canal, ended up blocking shipping traffic. And for days, there was zero movement, causing about 100 ships to be stuck, waiting to pass through. Pictures of this gigantic ship stuck in the narrow canal caused a huge show on social media. It would have been just fine if the global impact of the event stopped right there on the media. But the economic outcome was much louder than memes. It was estimated that the blockage cost about $400 million an hour, as westbound traffic was reportedly worth about $5.1 billion a day, while eastbound traffic was worth about $4.5 billion a day. In that period, a team of data and analytics experts from Dun & Bradstreet analyzed the impact the crisis will have on businesses in different parts of the world. And their conclusions are based on annual shipping data that tracks the vessels and materials found on board ships that travel through the Suez Canal. Through the study, it was discovered that Europe would feel the strongest impact of the blockage of the canal. Also, companies located in Asia will be impacted not only by the delay of shipments from Europe, but also by a shortage of empty containers returning to their region, further stalling their abilities to deliver goods around the world. Dun & Bradstreet took a deeper dive into the data for the US and Europe and discovered the following. In Europe, to be more specific, the countries most impacted by the crisis were the United Kingdom, Germany, Belgium, France, Netherlands, Italy, Switzerland, Spain, Turkey, and Austria. Also, the top economies in Europe that were most affected by this incident include eating and drinking establishments, construction, wholesale trade, chemicals and allied product-related businesses, health services, food retailers, industrial and commercial machinery and equipment, metal production, and automotive repair services. In the U.S., the 10 industries that were impacted the most by the crisis were grocery stores, department stores, auto and home supply stores, hardware stores, surgical and medical equipment suppliers, storage, general warehousing, and lots more. Now, what does this mean for global trade? The crisis wreaked untold havoc to supply chains, and the ripple effect from the grounded container ship would last long for global supply chains as it impacted everything from the clothes and shoes ordered online to gym equipment, electronics, food, and energy supplies. The man-made Suez, at 120 miles long, is a key transit point connecting east to west, and the 20,000 ships that pass through it yearly transport everything from oil and gas to machine parts and consumer goods. This made the crisis a major blow to the global supply chain, considering that it happened after a brutal year ridden with delays, shortages, and price squeezes on the back of the coronavirus pandemic. The blockage is likely to add to industry supply strains, which are already hampered by ongoing supply chain bottlenecks in the form of port congestion and shortages of both vessels and containers due to COVID-19, wrote J.P. Morgan. He added that ships were going to have to shift to entirely different routes, which would result in longer voyage times thereby, causing further delays. According to analysts, the delays had the potential to be more than 15 days for many ships, whose alternative was sailing around the Cape of Good Hope at the southern tip of Africa, increasing shipping times by up to 30%. Even after 2 years, the Suez tanker crisis remains a notable global phenomenon. It is yet another reminder of the interconnectedness that comes with globalization and our reliance on one another as contributors to the global supply chain. Companies have a high level of dependency on suppliers and third parties from other countries, and that dependency becomes more apparent when a link in the supply chain is tampered with. More than ever, the Suez Canal incident gives yet another reason for businesses to invest in data and technology to create an agile, geographically dispersed supply chain that can quickly pivot during unexpected events. Being a global phenomenon, the financial consequence of the Suez Canal crisis was huge. The executive vice president of product management and strategy for E2 Open, Pawan Joshi, said that considerable attention had been focused on the economic value of cargo trapped on vessels and their inability to move through the Suez Canal. The financial impacts on downstream production that depend on the timely delivery of these materials was magnitudes greater. For instance, the delay of an inexpensive but crucial automotive part en route from China can prevent the sale of the entire vehicle in Germany. He continued by saying that the ability to peer inside containers, understand downstream business impacts of transport delays, and systematically take corrective actions provides a distinct competitive advantage for global businesses. Before precautions could be taken, Ever Given's misfortune had already impacted oil prices. News of the Suez blockage drew in buyers, and along with other economic data, contributed to the international benchmark. Brent crude's one-month futures contract gained its biggest one-day gain in nearly a year, according to Arctic Securities. In that period, between 5% and 10% of all seaborne oil was transported through the Suez, meaning that for each day that the ship remained stuck, it delayed the shipment of another 3 million to 5 million barrels of oil per day. Several tankers carrying jet fuel and gas oil are also usually held up on the Persian Gulf-Europe route, as well as empty tankers crossing to pick up North Sea oil. While the incident has now been resolved, it's shown a light on a potential weakness in how raw materials, components, and finished goods are transported through choke points such as the Suez Canal, with possibly severe implications for the global economy. Now, to the good part. It is hard to believe that anything positive can come out of such a crisis. Yet the Suez crisis came with certain benefits, because, well, the canal blockage is certainly not bad news for everyone. For one, spot freight rates jumped even higher on pent-up demand, making more money for the operators. J.P. Morgan, fully involved in the case, predicted that a more prolonged closure of the Suez Canal would see container shipping as the biggest beneficiary, while tanker, dry bulk, and air cargo might also see some higher rates, describing the tightening of shipping rates as an upside risk. And he didn't get it wrong. We all saw it play out. The Greek ship-owning community, which controlled more than a fifth of the world's ocean-bound merchant fleet and more than half of the EU fleet, by weight, according to the United Nations, was set for a potential bonanza in rates. Time charters, which guarantee the owner a day rate, had the additional advantage of shifting the risk of delays to charterers. The alternative, voyage charters, in which charterers pay for a specific route regardless of its duration, left the owners exposed. Ziad Nakli, chief executive of TEO Shipping Corporation, another Greek owner and operator of so-called dry bulk carriers. That is, ships that transport cargoes such as iron ore and other such commodities, noted, "I don't expect many owners to be suffering. Most charters these days are time charters. Simply speaking, if a ship is delayed as a result of the vessel stuck in the Suez, the owner of the delayed vessel still gets paid by the charterer." While the Suez Canal incident demonstrates the interconnectedness that comes with globalization and our reliance on each other as contributors to the global supply chain, it also sheds light on the opportunity to tap into the benefits of a company's geographically dispersed supply chain. Even though some good things happened with the crisis, there are still lessons to be learnt. In today's ever-changing world, it has been discovered that it is not enough to simply onboard vendors and complete annual health and due diligence assessments on them. More importantly, companies must develop a data-driven, risk-based assessment process to identify and continuously monitor a variety of risks that could impact the productivity of their supply chain, thereby creating a more flexible and agile network that can navigate through any circumstance or during any unexpected event. That's it on the Suez crisis. We all must learn to see the good out of every seemingly terrible thing that happens. Please give this video a thumbs up and do subscribe to this channel. See you soon.